Our guest tonight says he's advising his clients to stick with stocks. Alan Haft is a partner at Kelly Haft Financial. Alan, welcome. Good to have you with us.
Hey, thanks for having me.
I'm sure you heard what David Tepper said. He doesn't seem to share your view. He says don't be too long. He said don't go short, but don't be too long. Why is he wrong, Alan?
Well, look, I mean, David Tepper's hard to argue, but I will have to, I'm reading this interesting book right now called Think Like a Freak. It's the guys that wrote Freakonomics. And in the book, I was reminded of this morning. They analyzed, there was a report there that analyzed 6,000 stock predictions over the last 10 years, and about 40% of them came true. So the prediction business is very, very difficult, especially in a time where there's so much mixed economic data. At the beginning of this year, everybody thought bond yields would be higher right now. They're not. The prediction game is very, very difficult, that's for sure.
All right, so Alan, why stocks?
Because there's nowhere else to put your money right now. For as long as the Fed is going to keep interest rates low, it's just last week Yellen said that they're going to keep rates low for at least a lengthy period of time. There's nowhere else to put money right now. So let me ask you this. If you can put your money into a 10-year treasury and get 2.5% for 10 years, does that sound like a reasonable investment? A lot of investors today flooded into the bond market, but they're going to be scratching their heads pretty soon and realizing, wait a second, we're not making any money in bonds, so as long as those rates stay low, which they will be for some time to come, there's nowhere else to go right now on this planet except for stocks, especially the ones that pay nice dividends.
There are a lot of stocks in the S&P 500, as we were pointing out earlier today, that actually yield more than the 10-year Treasury. But back to the point here, at the beginning of this year, I heard an awful lot of folks saying exactly what you're saying. Why do you want to tie up your money for 10 years at 3%? But so far this year, Alan, the 10-year bond has outperformed the S&P, the Dow. Lord knows it's outperformed the Russell and the NASDAQ. It's up in total return about 6.5%.
Great point. So here's where I would expand on that theory of staying in stocks. Because the market as a whole right now is very tricky. It's not very attractive. The bond market is outperforming the stock market as a whole, and segment plays in the market like sector funds. That being said, to stay in stocks right now, I'm a big proponent of staying in individual stocks. You got to get picky right now. You can't exactly swear by the indexes, swear by the broad sectors. Being very picky right now in stocks is really the best place to be, at least for the short term, because you're not going to make money anywhere else. And to your point, the market isn't doing too well this year as a broad measurement of everything that's going on.
All right, so help us pick some of those picky stocks. Name one or two for our viewers.
Well, I'm not a big fan of predictions, but I will say even prior to the show today, when we were on the call earlier, I did say AT&T was one of my favorites, especially for the longer term. Because look at a company like AT&T. It's paying a little over a 5% dividend, which is much, much higher than the bond rates are right now on reasonable quality companies. So if you're going to pick a stock like an AT&T and you're going to get paid 5% and those dividends are pretty reliable, if you have to stay in AT&T for 5, 7 to 10 years, will it be worth more than it is today? For my money, absolutely. So that's why stocks like an AT&T are a much better place for me to put my money than some long-term bond that's going to pay me 2%, 3%, and I'm going to have to lock up my money for that period of time.
May all your predictions come true, Alan.
I hope so.
All right, Alan Haft with Kelly Haft Financial.
Thanks.